you for joining us today. I'm sure all of us are eagerly waiting for the election results. They are very much around the corner. Today we have Athreya Ramkumar, research analyst at iThought, taking us through the presentation. He will be reviewing the IT sector and giving you a holistic view of the growth prospects, trends, and valuations. Without further ado, let me invite Athreya Ramkumar to take over.
Yeah, thank you, Tarun, for the introduction. Just wanted to reconfirm you're able to see the screen and you're able to hear me, right?
Yes.
Yeah, thank you so much. Yeah. So, good morning, everybody. Thank you for taking the time out to attend another True Blue webinar, our pure large cap product. So, today we're going to be talking about the current state and the future outlook of the Indian IT sector, specifically focusing on the tier one players. This is the chart of the world GDP growth over the past 5 decades. And it's clear that roughly GDP has been growing world over at 3% rate over the past 5 decades. However, the composition of GDP has really changed from the 1970s to the past 2 decades. You can clearly see from this chart that the importance of productivity growth has really increased in the last 3 decades, and it's only going to accentuate going forward. And the importance of tech is going to continuously increase in improving this productivity. Therefore, the demand for tech will only continue to accelerate in the future. If you now look at the Indian services exports, if the data for the past 20 to 24 years, you can clearly see that the Indian IT sector has been a shining light for India, and it's the first industry to become globally competitive. In 2000, the services exports in India was at $5 billion, and in 2022 it touched $150 billion, and in 2023 it's expected to have touched over $170 billion. So that's a massive 30 to 35x jump. At the beginning of the decade, there was a rise of beginning of the century rather, there was a rise of the offshore model, and growth rates were very high at the turn of the century, which was sometimes even up close to 40 to 50%. But these growth rates plummeted post the global financial crisis, which acted like a turning point, and it stalled between 2013 and 2016, where there were a lot of geopolitical issues, and there's a lot of as a service product players, which kind of restricted growth for the services players. Over the past decade, the IT services sector has compounded at roughly 10%, whereas the ER&D sector, which is a subsegment of the services sector, has compounded at over 13%. So the industry generally has grown at a healthy double-digit rate. Looking at the tier one IT players, these are the growth rates for the revenue growth rates for the tier one IT players, and you can see that they have been very volatile over the past 6 to 7 years. Pre-COVID in 2017 and 18, the sector saw subdued growth due to a lot of visa issues, and and because of the rise of cloud and SaaS, leading to a reduction in infrastructure management revenues. But subsequent to that, these companies kind of reinvented themselves, and there was a lot of demand for cloud migration and ERP modernization and so on. So those revenues saw strong growth, which nullified the decline from the legacy infrastructure management revenues. And there are also a lot of mega deals which were won in the sector, and there was a lot of vendor consolidation and so on. However, post-COVID, with the increase in demand for technology, and as companies from all industries became digital first, the IT sector saw strong growth in 2022 and 2023. However, you can see in 2024 that this demand really decelerated, and to high single digits, and some companies like Wipro and even Tech Mahindra were relatively flat year on year in 2024. To smoothen out the volatility over the past 5 to 10 years, I've just just look. This is a chart of the rolling 3-year growth rates for the tier one companies over the past 10 years. So what it means is that if the 2017 number is the 3-year compounded growth rate from 2014 to 17, and the 2024 number is the 3-year compounded growth rate from 2021 to 2024. So this kind of smoothens out the growth rates to reduce the volatility. So if you look at it on a slightly longer time frame, you can clearly see that the average, which is um, so you can clearly see that the just a second. Yeah, so the average, which is the red line, it has been growing at a lower double-digit rate, which is close to 10 to 12%. And one thing to clearly note is that the growth rates for Infosys post the introduction of Mr. Salil Parekh as the CEO, where they started focusing a lot on growth and on winning large deals, had really accelerated between post 2020, and they did outperform the sector from between the periods 2020 to 2024, and that's why even the company and the stock did really well. In the past 3 to 4 years. Of course, they have seen a subdued growth in FY24, and their outlook for FY25 is also subdued. But that is, I mean, their outperformance over the past 3 to 4 years has been commendable. But on average, these companies, or the industry as a whole, is growing at roughly 10 to 12% over the longer time frame, with Wipro and Tech Mahindra seriously underperforming over the past 10 years. So let's now take a look at the headcount addition for the sector. Headcount is a leading indicator of revenues, directionally at least. And on average, the tier one players have added roughly 60,000 people per year. But there was a decline in FY24 of over 60,000 people. Therefore, there's a delta of 1.2 lakhs when compared to the average. The stress on the sector is clearly visible if you look at just the headcount addition. And looking at the headcount addition for the top 6 companies in 2023, when these companies saw pretty strong mid-teens growth, their headcount also increased by in the low single digits or in the high single digits for certain companies. However, in FY24, literally most all of them except HCL Tech, which was the sole outlier, all of them reduced their headcount by low to mid single digits as well. Whereas HCL Tech actually increased their headcount by which was minimal, but they did increase their headcount by close to 1%, and they did see the strongest growth of 8% in FY24. If you look at the headcount over a 3-year period, it's been relatively flat for the sector across companies, and this is clearly reflecting the weakness in the sector. However, on the other hand, mid-caps, if you look at mid-cap companies, they have been improving their delivery models over the past few years, and they are gaining wallet share and market share from larger companies. And they have continuously added headcount both in FY23 as well as in FY24. And mid-caps exposed to the auto segment and digital product engineering and so on have had a pretty good last 2 years, and their outlook seems to be relatively strong going forward as well. However, something positive for the sector is that this is the Naukri job index for the IT services sector, and the job index for the IT services sector has seen the first increase in the past for the first time in the past 18 months, and this has continued in April as well. Therefore, the headcount, which is a leading indicator for revenues, seems to be kind of bottoming out, and there seems to be a marginal uptick in headcount, which is a good sign for the future of the industry. Now, looking at the geo mix for the companies or in the sector as a whole, you can clearly see from the chart on the screen that North America is a key market for all IT companies, and it is the biggest market for all the IT companies, especially if they want to grow. North America alone contributes to roughly 2/3 of their revenues, whereas for LTI Mindtree it's actually really high. It contributes to almost 75%, and Europe is the second largest market, and it contributes to roughly 30% or 1/3 of the revenues for the sector. So on average, if you take on average, North America and Europe contribute to 85 to 90% of the revenues of IT companies, at least the bigger ones, and the rest of the world put together just contributes 10 to 15% for these companies. And looking at the growth rates for different geographies in FY24, the blue bar is basically the growth rate for North America, and for most companies it has declined in FY24, except for HCL Tech and LTI Mindtree because of certain company specific deals which they had won. And Europe which is the second largest. So before moving on to Europe, North America, which is the biggest market for all these companies, saw a big decline, which is for them in low single digits, which is a big decline for them. Therefore, that had reflected subsequently on the revenues as well. Europe has done relatively well for companies across the board. Of course, for Wipro, they had seen a decline in Europe as well, and they had seen a decline everywhere. But Europe had performed well for these companies as a whole, and rest of the world also was relatively weak. Therefore, literally, except for Europe, most of the other geographies were relatively weak for these companies. And this is the sequential growth for the industry as a whole over the past 5 quarters. And you can see that over the past 5 quarters, the biggest market, that is the US market, has declined in 3 out of the 5 quarters. And even in the quarters where it has grown, it has only marginally grown. So it's been relatively flat over the past 5 quarters. And Europe, on the other hand, has done slightly better, whereas the rest of the world market has also done relatively better compared to the other markets. But the contribution by that is pretty marginal, so it didn't really reflect on the overall revenues. Let's now now that we looked at the geographies contributing to the revenues, we can now look at the verticals contributing to the revenues of the IT sector. And the biggest contributor to the revenues of these companies is BFSI or financial services. The BFSI or financial services roughly contributes to 1/3 of the revenue of the sector, and it's subsequently followed by various other sectors depending on the company. But the other big sectors are retail, manufacturing, communications, high tech, energy, and healthcare. However, one thing, there's a clear outlier here. Tech Mahindra, of course, because of their legacy and history, their communications division contributes to roughly 40% of their revenues. And the communications and telecommunications market globally is seeing a lot of reduction in spends, and that's why they are also facing a lot of they are also facing their decline in revenues. Therefore, their strategy, especially since the new CEO has come in, has been to diversify into other segments and increase the revenues of other segments. HCL Tech also historically has had a lower share of financial services when compared to its bigger peers. It has probably a more well-rounded revenue profile. However, but they are also starting to win certain large deals in BFSI and increasing their revenue mix in BFSI. And looking at this is the vertical growth for the top 5 for the top tier 1 companies over the past 5 quarters. And clearly, the first thing that sticks out is that BFSI, which contributes to over 30% of revenues for most of these companies, has seen a decline in all 5 of the past 5 quarters. Therefore, the biggest division for these IT companies have seen a decline, and retail and transport as well has, which is the second largest division, has also seen a decline. Health. So other divisions like healthcare and manufacturing have done reasonably well, as their industries are also doing very well globally because of the manufacturing boom, and the healthcare is always relatively steady right now. And to speak more about the weakness in BFSI, this is the commentary from all the top companies, and clearly everyone has been affected by the weakness in BFSI. However, certain companies are indicating that BFSI, the segment itself, has kind of bottomed out, and they are seeing some signs of green shoots. And if the segment has indeed bottomed out, then that will be a positive for the sector going forward. If you look at the tech spends by the BFSI clients globally, these are the major banks in the West, and their tech spends have actually increased year on year in the past few quarters. Therefore, the clients are actually not reducing their tech spends much. It's just that the revenue which is flowing through to the IT players, that is reducing. Um, Therefore, it seems to be that these at least the tier one companies seem to be losing some kind of wallet share with the global BFSI players. Just to touch up on that, this is the revenue growth for the overall Indian IT sector versus the Gartner IT services spends over the past 10 or 15 years. And you can see that the entire Indian IT sector has actually outperformed the Gartner IT services spends over the past 15 years. Therefore, Indian players are really gaining market share over when compared to the world player when compared to the world. So there's a lot of offshoring which is happening in India. However, if you take the if you compare the same Gartner IT services growth to the growth of the tier one players, the tier one companies have actually underperformed Gartner IT services growth in most of the years, with the sole exception of 2021. And even in 2018 and 2022, they just kind of about matched the growth of the Gartner index, whereas in the other years they have actually underperformed the Gartner IT services index, and in 2023 and 2024 they have significantly underperformed. Therefore, tier one companies seem to be losing out some market share, at least in the services exports from going out from India, and uh, they are probably losing out share to smaller companies. And another major trend, which is the global capability centers, or GCCs. So this is the revenues of global capability centers compared to the Indian IT services itself. And over the past 8 years, the GCCs have grown 3 percentage points faster than the top five IT companies every year since 2015. The GCC's revenues have scaled from $20 billion in 2015 to over $50 billion in 2024. There are a lot of drivers which is driving the demand of GCCs. The main reasons for this is that the clients have a lot of core work, with respect to sensitive projects related to intellectual property and customer data, and this kind of work cannot be outsourced just because of cost cutting pressures and things like that. Therefore, what they are doing is that they are reshoring their own employee base to from the US and other Western markets to India in a bid to reduce their expenses. Therefore, the GCCs are actually gaining market share, and they are increasing their employee base in India. And so BFSI, which is the biggest sector, contributing to 1/3 of the revenues of the tier one IT players, this sector has around 30 to 40% of their technology staff or their IT staff in India. Therefore, they have really made a big move in offshoring their internal employee base to India. Of course, the cost of per employee is almost 3 times higher than the tier one IT players. And if you look at the related party pricing, because these GCCs are not really profit centers, they're more of cost centers. So the pricing to their global MNCs, which will just be on cost plus, maybe because of transfer pricing, on the margins or the spreads will be extremely low. Therefore, the pricing for the contracts for which they do to their global head office is much lower than the tier one IT players, and that's also putting some kind of pressure on the IT companies as well. And most importantly, if you take a look at the outsourcing ratio, historically the amount outsourced was at 60%, whereas the amount which was held within the companies was roughly at 40%. However, this equation has kind of flipped over the past few years, and it is now the amount outsourced is at 65%. Sorry, the amount outsourced is only at 35%, whereas the amount which is kind of insourced is at 65%. And however, people and industry experts estimate that this is expected to stabilize at at 70/30 ratio, and therefore the headroom to grow for or else the downside to for outsourcing is actually limited from here onwards. And just some data points on the increased insourcing. You can see that these are the headcount numbers for the top 5 BFSI firms in India, and these firms have a huge employee base in India, and the JP Morgan has over 50,000 employees. Bank of America has 25,000, HSBC has close to 40,000, and it is only increasing. Therefore, most of roughly 30 to 40% of their tech base is in India, and that percentage is only expected to increase going forward. And these are also some headlines recently in the newspapers. And I think Amex opened their largest office worldwide in India, and of course, JP Morgan, like we saw, has the highest employee count in India as well. And the past year has also seen these are just two major examples of insourcing in BFSI, which affected the tier one IT players. Both TCS and HCL lost some of their one of their big clients, because their clients felt the need to bring their work back in house, as companies try to tighten their spending and restrict their budgets. However, one thing to note is that the outsourcing versus in-house debate is extremely cyclical. Therefore, IT companies provide a lot of flexibility to these clients, and therefore the relevance of the IT sector and the outsourced model will not wither away. Its importance in the past few years, but it will in the future again gain some importance, as we have seen in the past, because it's extremely cyclical and they provide the flexibility that the clients need in the future as well. Before I begin, the definition of the disclosures made by different companies is actually very different. Therefore, TCS discloses their entire order book, whereas Infosys only disclose their large order deals, which is greater than $50 million, and HCL Tech only discloses their net new wins. Therefore, it's not strictly comparable, but it gives us some kind of trend or direction and some color on the trajectory of order bookings. Therefore, you can see that in FY25, the order wins trajectory has actually been pretty healthy, and it has it has been for the it has actually accelerated for most of the companies. But we also saw that FY24 the revenues were had kind of decelerated, and FY25 the outlook given by most of these companies are also pretty weak. So this kind of is perplexing. So let's take a look at why this. What's the difference in because of this? This is the chart, this is a chart which shows the revenue in the current year divided by the opening order book, that is the order book orders won in the prior year. And you can so of course this is not comparable across companies, but for each company, if you look at it, this gives some, it is not useful for predicting revenues as well, but it gives some kind of directional color. And you can see that for all companies, uh, the revenue by opening order book has actually really decreased over the past few years. And this and for Infosys, in FY25, based on their growth guidance, the revenue by opening order book will probably be close to 110, 115%. This clearly means that for Infosys and for other players, that there are a lot of smaller deals which are lower than maybe in the $1 million to $10 million bracket, and the smaller clients are not renewing they're not renewing their deals, and there's a lot of churn which is happening under the surface. And if you look at TCS's numbers as they report their entire order book, even for them, it's really declining. Whereas it was 100% in 2020, it's now come down to 85%. This also indicates, apart from the churn, that the tenure or the average contract value, the tenure is also increasing. That leads to a reduced average contract value or annual contract value, and that is also leading to weak revenue conversion from the deals. Therefore, the tenure is kind of elongating, and in certain earnings calls, the IT CXOs have stated that the tenure has increased by 20 to 25%, and there's also a lot of churn in their lower ticket clients. And therefore, the large order wins which these companies report is kind of not translating into strong revenue growth. And this is Mr. Jatin Dalal, the ex-CFO of Wipro and the current CFO of Cognizant. He clearly, he kind of really explains this pretty well in an industry call. Basically, what he's saying is that outsiders or analysts kind of assume that there is a stable base in revenues, and these large deals are just are adding on top of that. However, that is really not the case, because he states that in the existing business there's a lot of ramp downs, and there's a lot of and because of the lack of discretionary spends and the lack of lower ticket size deals, they are the larger deals are actually only replacing the reduction in ramp downs, and this is not you know uh, reflecting in revenue growth. Therefore, he calls this a leaky bucket. And what he says is that in 21 and 22 there was no leaky bucket. Therefore, there was basically, he means that there is no lack of churn which was seen in 21 and 22, and the large deals actually accelerated growth, and that's what led to the 15 to 20% growth rate of the larger players. What he's saying is that right now the churn and the lack of discretionary spends is the highest they have seen over the past 5 years, and he expects that as the macro situation turns, especially in BFSI, as the interest rate starts falling, and BFSI clients start spending more, and there is a reversion to mean there in the outsourcing as well, then the discretionary deals will start flowing through to them, and only then will the growth rates really start accelerating. And now let's take a look at the client additions over the past few years for these companies. And on the bottom left, if you take a look at the Infosys numbers, you can clearly see that once the Mr. Salil Parekh was appointed as the CEO of Infosys, they started focusing a lot on large deals, and they really won many large deals, and even a few mega deals, more than $1 billion, and that led to their outperformance over the past 3 to 4 years. Whereas and one thing which is common across these companies is that in 2024 their net client addition saw a real deceleration, and Infosys actually did not even add a single client in the greater than 100 million bucket, which of course they are also seeing some subdued growth which they're projecting for the next few years. And Wipro has seen a lot of churn in their clients, and their numbers are really volatile. TCS, on the other hand, has been, which is on the top right of the screen, has been a very steady player. They have been adding a lot of clients across buckets over the past few years, and they have won a few mega deals in the past year, most notably the BSNL deal, which is a really strong deal, and that deal has been ramping up over the past few quarters, which is leading to outperformance when compared to others. And if you look at HCL's net client additions over the past few years, they have struggled in winning large and mega deals. But in 2024, they did win a few mega deals, most notably the Verizon deal, which is close to $2.1 billion. And of course, if you look at the $1 million clients and the $10 million clients, they have been, especially the greater than $1 million client pool, the net client addition has been really poor over the past year for all the companies, and that's leading to lower discretionary spends and increased churn. Of course, now we had covered this topic in our previous webinar, which is in depth, which is on YouTube, which you can probably check it out. But I'll kind of summarize this. A lot of people think are of the opinion that the boom in foundational models or generative AI will increase outsourcing or increase tech spends by clients, and that will lead to a surge in revenue growth for IT players. While that may be true in the longer term, at current, it's enterprises are actually in an extremely early stage. So most of them are only in a proof of concept stage, or roughly 50% of them. Therefore, the deal sizes for these companies, which the tier one IT players are attracting, is extremely small, which probably be in the few $1 million. So they cannot really move the needle. And on the left of the chart, you can see that 40% of the 40% of the clients, or 40 or of the industries are not even looking at adopting any AI specific tools. Therefore, the enterprise adoption, it's clear that enterprise adoption will take time. Therefore, it's not going to be something which really boosts revenues in the near term, especially with these foundational models. However, with the boom in LLMs and other foundation models, the transition to the cloud will only accelerate. And this is a comment made by Andy Jassy, the CEO of Amazon, in the latest earnings call. Therefore, he states that 85% of the global IT spend is still on premises, and he believes that this equation will flip to 85% being on the cloud over the long term, say 10-20 years. Therefore, for anything, if enterprises really want to make use of the data that they have, and with data they have, and they want to use new technology, they really need to move. They really need to move their data from on premises to the cloud, and they have to modernize their infrastructure as well. Therefore, in this boom, because of the reacceleration rather in cloud migration and modernization of applications and things like that, that can be a positive for the IT services sector, and maybe in the next 1 or 2 years that can start, especially if the macro environment becomes better, that can start reaccelerating their revenues as well. And just to summarize this, right now the impact of AI is, it's too early to conclude what the impact will be. It contributes less than 0.5% of their deal wins today. One potential positive is that, and it is happening, especially in the last few quarters. If you notice, the hyperscalers have seen reacceleration of revenues, and therefore reacceleration in cloud adoption will see improved growth. We'll see improved revenue traction for the IT services players as well. And on the margin side, these could help IT companies achieve their annual productivity improvement gains, which are inbuilt in IT contracts. Therefore, outcome-based pricing, which is a norm right now, will not be as much as a hindrance going forward. Of course, we have to wait and see how it it impacts the sector. And other potential benefits are that, of course, increased pyramidization of their employee base and increase in utilization as well. On that point, let's now talk about their margins. If you look at the margins of the IT sector over the past, from 2014, the margins actually have been on a steady decline, with the sole exception of TCS, who has been at a 25-26% band. Everyone else has seen a 2 to 3 percentage decline over the past 10 years. And of course, Wipro and Tech Mahindra are at the bottom of the pack. One thing to note is that the USD INR rate in this time period has actually depreciated by over 35%. And it's contrary to popular opinion, because many people think that these companies, the margins of these companies will improve because they'll benefit because of the dollar depreciation and so on. But because increasingly over the past few years, a lot of these contracts have cost saving clauses which are baked into the pricing, or outcome based pricing. The improvement or the increase in margins which the companies are finding because of any currency depreciation, they are being forced to part with them, and pass them on to their clients as well. Therefore, they are not really seeing any improvement in margins because of currency and so on. The one statistic to note is that the cost saving clauses in deal agreements was 20% at the beginning, in 2014, 2015, and these cost saving clauses has gone up to 50 to 60%. Roughly 50 to 60% of contracts have these kind of clauses right now, and it's only increasing going forward, because clients also, especially in large deals, clients want the IT services companies to have a stake in the outcomes. Therefore, they want them to have some skin in the game, and that's also leading to a stagnation in margins for the IT sector players. If you look at we'll take a look at the top two companies. So TCS, especially if you look at the gross margins on the left, so it's clear that TCS had a gross margin of over 40% till FY 2016, around that time period. However, subsequent to that, their gross margin has continuously declined and has gone down to around 34%. But their EBITDA margin, like we saw, is relatively flat at 26, 27. I mean, at 27%. This is because their other expenses and has really reduced from 10% of revenues to 7% of revenues. So there are a lot of discretionary expenses, travel expenses, facility expenses post-COVID have really reduced over the past few years. Which is allowing them to have a steady EBITDA margin. But maybe in the next few years, as world really opens up and as business goes back to how it was, they might actually have some uh, some headwinds to margins. But if you notice the split in the gross margins, the employee expenses, which are close to 50% at the big, at 2014, has continued to increase and is right now at 58% of revenues. And that really, the employee expenses has really increased for the company. And if you take a look at subcontracting expenses, TCS has really managed it well. They have not really seen a huge increase in subcon expenses when compared to the industry, and they have actually seen in 2024 a big decline in subcontractor expenses. Whereas they have hired more people. I mean, they have shifted the ratio to in-house people in the past year. However, if you now let's take a look at the Infosys margin profile. And till 2012, 2013, the gross margins of Infosys was also at 40%. They were relatively on par with TCS, and the early part of the century, they were actually much higher. But subsequent to that, the gross margins of Infosys has only been falling consistently over the past 10 years, and it has fallen down to 29% in 2024. And Infosys, on the other hand, it's pretty interesting. So we saw that TCS, the employee expense of TCS, moved from 50 to 58%, whereas Infosys, on the other hand, has focused more on their subcon expenses and have not really increased their employee in-house employee base. Therefore, their subcontractor expenses, and of course the software packages, which is part of the deals that they're winning, has increased to from 10% in 2020 to around 17% in 2024. Therefore, they do have some kind of headroom to improve margins, but it will be tough for them to do that going forward. And if you notice, their other expenses, just like TCS, they have also reduced their other expenses from 10% to 6% over the past few years. And their EBITDA, because of the increase in subcon expenses over the past few years, their EBITDA margins have really seen a decline of 3%. And they have internally, they have started a program to find areas to cut costs and to reduce subcon expenses, and of course increase utilization and things like that. Now let's take a look at certain ratios and factors affecting the margins. Attrition levels, which generally which was high, really high post-COVID in 2022 and 2023. You can see that attrition levels really spiked for every company, and for Infosys, it even went as high as 28% in 2022. Has really substantially reduced in 2024, and it's close to pre-COVID levels right now. And if you notice the chart, TCS has been has been the industry leader in low attritions, and in a business which is about managing people, this is kind of a clear leadership sign, and it's a positive sign for them. Uh, Another thing to note is that the attrition, in say pre-COVID, uh, was kind of similar for the other three players apart from TCS, but there was a huge gap between TCS and the other three players. There was a 5 to 6 percentage points gap. However, in 2024, while attrition has declined for everybody, the gap in attrition levels is almost zero. It's pretty much the same. This clearly shows that the fight for talent has reduced, and potentially the job market in the IT sector is pretty weak, and in the tech sector especially is pretty weak in India and globally as well. Now let's take a look at utilization levels. The utilization levels are pretty high for most players, and there is not significant headroom to improve utilization and to increase margins for them. Infosys has some kind of Infosys, Persistent, and Emphasis have significant headroom to improve utilization, but increasingly, for as revenue growth starts kicking in, these companies will have to start rehiring. And I think that's why you see announcements of tier one companies in the newspapers that they're going to go they're going to go to colleges this year, and they'll be hiring freshers as well. And looking at the employee pyramid for the top two companies, because they have reported it in the past year, if you look at the employee pyramid for TCS and Infosys, the TCS actually has a much almost 7 percentage point higher number of juniors when compared to Infosys, and the number of seniors or the senior executives for TCS is significantly lower than Infosys. Therefore, I think Infosys is also trying to change their employee pyramid and increase the number of freshers and junior employees, so that they can also restrict their the employee expenditure and improve their margin profile in the future as well. And almost all companies are trying to do this. If you notice, I think HCL Tech also, they did not have their pyramid was not the best in 2021, and they kind of struggled because of that, and they have really started ramping up their fresher hiring in the past few years. Now, looking at the PAT growth over the rolling PAT growth over the past decade, you can clearly see that the industry as a whole has been they generally grow their profits at a lower double-digit rate between 12 to 13%, and across companies they have been really consistent in growing their profitability on every rolling 3-year basis at a double digit rate. In 2018, and you can see that between the time period 2018 and 19, or even 2020, the industry really struggled for organic growth, and the PAT growth percentage kind of dropped in the high single digit, to the single digits. But subsequent to that, it really accelerated. And Infosys, of course, we saw how their revenues really took off, and their profitability also really accelerated from 2018 to 2021. And in 2024, most of these companies did see a deceleration in PAT growth to high single digits, but on average they have been growing at a low double digit rate. And if you take a look at the payout ratio for these companies, post 2018, there has been a remarkable shift in the payout ratios for these companies, and with the top companies really paying out a lot, almost all or 100% of their profits, and in the form of either buybacks or dividends. And even certain companies, so HCL Tech, from 2022 onwards, they changed their dividend policy to pay out more than 85% of their profits. And even Tech Mahindra in the past 2 years have started paying out a lot of their profitability, paying out a lot of their profits as well. And what this does is that it kind of shrinks the balance sheet, as these companies do not, I mean, of course, the best thing would be is to reinvest their profits, but these companies are unable to reinvest their massive profits which they are making each year. Therefore, as they start paying the excess cash out, what this has done is that the return ratios and the return on invested capital has really seen a surge in the past 5 to 6 years. And you can see that you can see the increase for all these companies. And this is their core return ratio if you exclude the cash on the balance sheet. And for HCL Tech, it's more noticeable because they only started paying out a lot in the past 2 years. You can see that their ROACs have increased from 25-26% to to close to 40% in just 2 years. Therefore, there has been a really high remarkable shift in the return ratios as well. And this is the justified P, mathematically speaking, for different ROIC ranges and for different growth rates. We saw that these companies are growing their profits at a low double digit, 10 to 12% on an extended time period. And their ROICs have really improved over the past few years. And inherently itself, there are return ratios for this kind of business model is very high, but they have ROICs of upwards of 30-40%. And you can see that clearly for this kind of a return profile, and even for, let's say, a high single digit growth rate, that kind of business model mathematically should attract PE ratio of upwards somewhere between 20 to 25 times. And this is assuming that the cost of capital is 12%, and that you want or in other words, you are fine with a 12% rate of return. If you want a higher rate of return, the table will change. But yeah, assuming that, given that these are kind of large caps. And speaking about valuations, let's looking at the historical valuations. This is the IT indexes historical P multiple over the past 10 years. And right now the the IT indexes multiple is around 26 times, whereas which is roughly in the third to fourth quartile. And whereas the median PE over the past 10 years is around 21 times. You can see that the sector bottomed out somewhere between in 2017 when the valuations really cratered to mid to high teens. And like we saw in the previous chart, for this kind of business model, especially with the return ratios improving and growth rates being at close to double digit, that is a really attractive place. Of course, as growth started reviving, the valuations also went in excess, so one can say, in 2020 to 2022, and that has kind of corrected right now. and it's kind of trading in at around 25 times at the moment. If you look at the forward multiples as well, the Nifty IT index is trading slightly above a one-time standard deviation to the mean, and of course at 26 times, which we spoke about just now. And if you look at it relatively, the relative valuation to the Nifty is around 25 to 30 times, which is slightly higher than significantly higher rather than the historical past. Whereas if you compare it to, say, the Nasdaq is trading at a similar multiple with respect to the Nifty IT. And this is the Nifty IT to Nifty ratio chart. Therefore, you can see that this is for since the late 90s, and you can see that the ratio went to the lower the better it is for incremental investors. So and if you're already invested, it's of course the higher the better. And you are in 2022 or in late 21, this ratio kind of peaked out at 2.2, and you can see at the beginning of the chart that the 2000s it was really high because of the dot-com bubble and so on. Right now, it's at 1.45 times. Therefore, it is coming to reasonable levels, coming to and more attractive levels than what it was in the past few years. And looking at the performance of the sector, this is the Nifty IT index year to date has seen a drawdown of around 8%, whereas the Nifty has gone up by 3.5%. There's a 11.5% delta between the two. There has been an underperformance by the index in the current year because of the weaker outlook which the companies gave for FY25. Now, speaking about the outlook, in calendar year 24, Gartner actually in April they released their estimates. They're actually estimating that the IT services growth for the world will be at close to 10%. This is actually contradictory to what the IT services players, especially the tier one guys, are projecting for FY25. So it looks like they are still struggling, whereas the others can see some kind of growth. But this is if you notice this 2023 growth number, it is at 6%. Therefore, there is a clear kind of a revival in IT services spends, and it seems like the services spends is bottoming out, especially in BFSI, which is the major contributor to revenues for the sector. And of course, a more favorable macro environment, if there are some rate cuts, maybe post the US elections, then that could even act as a further kicker as well. And this is McKinsey's projection for the next 3 years, and they are actually estimating that the traditional IT services sector will be compounding at over the overall market itself will compound at 8%, and whereas the ER&D sector will be growing at anywhere between 10 to 12%. And on the outlook, historically, tier one IT players have seen a big correlation in their revenue growth with the revenue growth of the S&P 500, and the correlation is upwards of over 90%. And if you and the estimates for the S&P 500 EPS growth or the revenue growth for for 2024 calendar year and 2025 is in the mid to high single digits. Therefore, it is possible that the tier one IT revenue growth will probably bottom out this year and see some signs of green shoots in the second half of the year. And these are the consensus estimates for the top 6 IT companies. And if you look at the median EPS growth for the next 2 years, I think the sell side is also estimating that the profit growth will be anywhere between 10 to 12% over the next 2 years, and they'll be trading at 24 times 1 year forward, and 20 close to 19 times 2 year forward as well. Now, taking a look at the fund flows from the mutual funds to the sector, this is for it's highlighted here. You can see that the the weights or the allocations to the sector has consistently declined over the past 1 year. Therefore, mutual funds as well. And the weight in the Nifty 500 for the IT sector is right now close to 9%. Therefore, from slightly overweight position, the mutual funds are now, are in a slightly underweight to neutral position in the sector. Therefore, to conclude, although the near-term outlook for the sector is kind of benign. Gartner is estimating a 9% growth in 24. McKinsey is estimating a high single-digit growth rate till 20 in the next few years, and even the S&P 500 revenue growth estimate is at a mid-single digits for 2024. And this is coupled with strong large deal wins, which we saw that every company was really winning. Therefore, as the macro situation kind of turns and people start focusing more on improving, not just on reducing budgets or restricting budgets, and to improving, and the clients start focusing on improving customer experience and their products, that can really provide a kicker to revenues maybe in the medium term. And take a look at margins. Attrition is back to pre-COVID levels. Utilization has for certain, I mean, it's company specific, but for certain companies they can trend upwards. And of course, the headwinds are that there's because of GCCs and revival in travel and facilities expenditure. Therefore, that is the headwind. So it will be we'll have to wait and see how how companies navigate this. TCS right now they're at an EBIT margin of close to 26% in Q4, and they are targeting. I mean, they have always targeted to be in the band of 26 to 28%, and we have to wait and see how they execute that. And right now, these companies, most of them are trading, because they pay out most of their profits, and they are trading in a, they have a payout yield or a dividend slash buyback yield at roughly 3.5 to 4% at the current moment. And on the valuations, like we saw, it's neither cheap nor is it like too expensive. It's relatively fairly valued. Of course, if growth is missing in the next few years, or the growth is, the revival of growth is pushed back by a year or two, then you might have to reevaluate. But right now, for the return, for the expected profit growth and return metrics, it's relatively fairly valued. It's not tilted towards either side. And on flows, uh, we saw most of the institutions have been sellers of the sector, and any revival in flows will only be a positive to the sector incrementally. So that concludes my presentation for today. And just before, so this is yeah. So I'll just spend a few minutes on the fund. So I'm going to True Blue is I thought's 100% pure large cap fund, and uh, we don't like people in the industry. We don't invest in small or mid caps to boost returns, so to speak. Therefore, if you are interested in if you are interested in a larger cap strategy for your wealth, then it's definitely a product to look at. And this has a very high active share. We don't really hug the index, and there is low churn as well, because we take at least a 3 to 5 year kind of view. And of course, the founders are Mr. Shyam Shekhar and Mr. GR Balaji. And GR Balaji is the head of research and co-fund manager. We have a huge investment team with varied experience in across sectors. So thank you. And if you have any doubts, please put it in the chat box, or if you have any questions. Yeah, so I see a few questions. So Mr. Ramani is asking whether IT companies hedge their forex variations. Yeah, they do that because these companies operate in all over. They operate all over the world. They are exposed to various currencies. Therefore, they do not want to be taking currency risk as well. Uh, Therefore, they do hedge most of their forex positions. And Mr. Karthikeyan is asking, are we reducing allocation to IT in TrueBlue? Uh, so we are not technically reducing allocation because we were in the past 1 or 2 years we were actually underweight IT, and we take more of a company specific call. We don't really take a industry specific call. We were anyway underweight IT in the past few years, and I think we did kind of trim certain positions in the past year, but yeah, it's more of a company specific call. Yeah. Yeah, thanks, Mr. Manikumar. So, what can we expect ahead? Yeah, what you can expect is that I think the management teams have also, even globally, if you look at the commentary of global peers like Accenture, Cognizant, and so on, they are expecting that the next year will be pretty tough for the sector as a whole. Uh, they expect some turnaround only towards the second half of the year or maybe early next year. Therefore, I mean, business wise, these companies will have it'll be company specific. They'll have to win deals. Certain companies will have to will win large deals to negate the impact of the industry and gain market share as well. Therefore, you'll have to be very company specific. The industry as such is not seeing any tailwind in the next, at least for the next 12 months. Mr. Damodaran is asking, is it the right time to start investing in IT majors? I mean, that's a call you will have to take. But one thing, if you can see, is that generally, historically, at least, these companies, the valuations of the companies will bottom out when the payout yield or the dividend yield is above 4.5% and roughly close to 5%. That is close to 20 times price earnings. At that kind of price, at that kind of range. Uh, the industry as a whole will start looking pretty attractive. We did see that these companies can with their return ratios and growth rates, they can trade at in the mid 20s as well for a long periods of time. There other Apart from that, you'll have to look at the execution by each company, execution done by each company as such. Ms. Aparna asks, between large and mid-sized companies, is the growth more for smaller ones for future? Of course, for the future, I mean, if you're on a low base, the growth will be easier to get if you're smaller, and at least the mid and small cap companies, even though they are also affected by the industry decline, as you can see, their growth rates have decelerated. They are growing at a slightly better rate. But one thing to note here is that the valuations for the mid cap and small cap companies, at least for majority of them, they're priced to perfection. Therefore, any small change in sentiment in growth for these kind of companies will see a big draw, and you will see a big drawdown for them. So you'll have to be pretty company specific at this point in time for the mid and small cap, because their valuation, they're really priced to perfections and valuations are pretty high. Yeah, so Mr. Chandru asks, how many IT stocks are there in the True Blue PMS? It depends from client to client based on when you joined. But roughly, I mean, in the True Blue PMS, the focus on the Nifty 50, and depending on our thought, we'll have anywhere approximately three IT companies in the PMS right now. Kalei Selvan asks, what is your suggestion for the small retail investor? suggestion would be you just you try, if you're a retail investor, you will have to this for everybody, but uh, of course you'll have to restrict your downside. Then you will really do well. If you restrict your downside, then these companies, the tier one companies, at least the management quality is generally really impeccable. Therefore, if you really restrict your downside and pay if you don't pay up for these stocks, then you will have a good experience in investing in these companies. Like I said, these companies, some of them are trading already at approximately a 4% dividend yield. Maybe that can, if that if the growth kind of accelerates from here, even that is pretty attractive. But if they get to 4.5% yield or above that, then it becomes really attractive as well. For small companies, what should be the indicators to track? Is it like small mid-cap companies are taking share? Yeah, so for smaller companies, one, you will have to track their. There's no like magic formula or certain indicators which will really provide an insight to them. You'll have to look at it holistically. But it'll be pretty much the same indicators you use to track large caps or any other IT company as well. You can look at how their how their orders are progressing, their revenue is accelerating, how their leadership team, since it's a business of people, their leadership team and the people management skills are really important. And you can look at their off-site on-site ratios, how much and their geo mix, their like what we discussed in the presentation, their geo mix and the verticals mix, and how many large deals they're winning and things like that. So that will give you some kind of indication on the execution capability of these companies. And Shilpa asks, what about IT product companies? Would it have different outlook than services? Yeah, definitely. So IT products is a separate subsegment itself, separate segment rather. And therefore, in IT products, it depends on the product of each company. And those companies globally and in India will have they can really, depending on the product and how the product is and how their sales team is structured and things like that, they can really grow at a much faster pace. And of course, it's they are also valued at a much higher level than services companies as well. Karthik asks, can I invest in IT or digital fund? Uh, yeah, for the long term, you can definitely. We are not here to give recommendations for where to invest, so you'll have to take a call on your own. But if you believe in if you believe in that technology, the importance of technology will only improve or increase in the future, then these companies will eventually, maybe in the near term, they are facing some growth challenges, but eventually, once the macro stabilizes, they will definitely start seeing some growth revival. I think Bharat is also asking asking similar thing. Yeah, it depends whether it's the right time to accumulate IT companies. It depends on each company, but yeah, valuations are kind of getting kind of getting attractive. You can see if you have to take a judgment call on whether you feel it'll fall even further, uh, or whether they'll actually pick up from here. Yeah, if Mr. Ramani asks if they are hedging their forex variation, then the advantage is lost. Is this? Yeah, that's what I was also saying. The hedging is also there, and they of course they do not hedge their entire position. And apart from hedging, also they uh, like if the cost if the cost, since the let's say the cost of an IT employee has been stagnant, at least in the junior level, at 3.5 lakhs for the past 10 years, the dollar cost is actually lower. I mean, dollar cost will be much significantly lower, right? Therefore, the billing rates also are have kind of declined in dollar terms for these kind of for the IT companies. Therefore, the clients themselves, they realize that in dollar terms, the IT companies are benefiting, so they are also pushing the price down. Um, so basically, the benefits are being shared between the customers and the vendors. Therefore, yeah, it's not. You should not look at it as a play on the. It's not like gold or something where you're looking at it as a play on as a hedge on currency. So in the near term, they will benefit from, let's say, for a quarter or two or maybe 6 months, they will benefit from these kind of if there's a sharp currency depreciation or appreciation, whatever, depending on how you look at it. But over the longer term, this advantage is lost. Uh, you see somewhere down the line margin profile. Abhishek asks whether the margin profile gross margin can get back to 40 to 50%. Can this be spurred by AI led gains? Right now it is. I think it's at close to 35%, right? Therefore, to 40, it's very unlikely that they'll go to 40 to 50. They go back to 40 to 50% gross margin. Like I said, these companies. One thing which has happened is that there are a lot of small IT companies which has mushroomed in the country and globally as well. Therefore, the sector itself has become a bit commoditized, and the pricing improvement which they would have seen in the past has actually been negated right now. Therefore, gross margins, can AI or things like that, pair programming and things like that, lead to some kind of productivity gains? Probably yes, but especially maybe in software testing and things like that, it can be automated. But I think a 5 to 6% gross margin improvement will be hard for them to achieve. I think gross margin can marginally inch up only from the current margins. Shakti asks whether as the IT services companies considering opportunities and challenges, one can expect EPS CAGR of 10 to 15%. And are they showing any interest in streamlining revenue through product innovation? Yeah, historically, over the past 10 years, we did see in the presentation that their profit CAGR, even on rolling every 3 year rolling basis for the past 10 years, has been between 10 to 15% at max. Therefore, unless something drastically changes, this is not going to change. This industry, at least the industry will be compounding at that. Companies maybe can outperform the industry and compound a bit further, but yeah, they would be growing at that range only. And are they streamlining their revenues through product innovation? I think many of these companies have they do have a lot of software products as well, but their main focus is not selling products, because the DNA for selling products is way more like really different when compared to for selling services. Therefore, these companies are pretty much they are happy with the industry they are in. I think HCL Tech, they did make a big acquisition in 2019 from IBM, and they do have a big software product division, but and they are kind of trying to they are trying to diversify, like what you said. But yeah, I think they are. I mean, they are kind of struggling right now in the product division. It's not really growing fast. It's growing at 1 to 2%. But they are looking at that as the future. And yeah, but I mean, overall, if you see, the DNA of these companies are kind of different. So while they are showing interest, it's not moving their top line, so to speak. Yeah, thank you, everybody. What is the max P which we can give for an IT company? So, I mean, it depends on the leadership and with the stability in these companies and so on. Because like, if you take a look at Infosys, prior to the current CEO, there were multiple CEO changes in multiple time periods. Only in the I think Salil Parekh has now been reappointed last year for another 5-year term. So this is the first time in a long time that Infosys has had stability in the CEO as well. So things like that also matter for a company. Because we can see what's happening with Cognizant globally. They've had multiple CEO changes and so on, and they have really lost market share globally. But I mean, if you mathematically speaking, I think we spoke in the presentation as well. For a company with return ratio, return on invested capital of 30-40%, if they're growing at high single digits consistently, or even low double digits or high single digits, then you can pay 20 to 25 times multiple for these kind of companies. It won't be it won't be too expensive. Yeah, Suresh Shah's changes in top management compensation, um, composition. Sorry. Yeah, there has been there have been a lot of changes over the past few years. I think TCS themselves have seen a change. Infosys, Infosys, while at the CEO level, they have not seen a change in composition. The second rung leadership have all left Infosys to go on to become CEOs in other companies. Like Cognizant and so on. Therefore, there has been, and even Wipro, of course, has seen a recent CEO change. Yeah, that is definitely a worry and an opportunity for depending on the company. If the company has been really underperforming, then you can, if a new maybe a new CEO might bring in new measures. They can really correct the shortcomings of the company as well. High loss of employment in IT sector after US elections. I think I mean, I'm not a specialist or an expert on the US elections, so we'll have to wait and see. But yeah, increasingly it is becoming harder for Indian companies to take their Indian employees on site because of visa issues and so on. But on the other hand, most companies most clients post COVID are being more receptive to to an offshore employee base. Therefore, yeah, we'll have there is you have to wait out and see what happens. Can we see mergers in IT sector? We have to wait and see. I don't think there's been a huge merger or anything as such in the past decade. It's only like private equity companies have acquired these IT companies in the past few years. And any dark horse, I mean, you said it yourself. You can look at companies where there have been, management changes and who have struggled in the past few years. And if they are, if the new management team really does well, then there can be, a revival in the growth of the company also. Yeah, Alagiri asks, is it the right time to SIP in IT sector funds? I think again, like, we're not here to give you recommendations, but it depends on if you believe in the medium term prospects or the long term prospects, then all I can say is that the valuations are starting to get, rather, it's not yet at very interesting levels, but they are, you can, they are starting to get to interesting levels. And from YouTube, Vipul asks, is there a way to participate in cyber security team? Of course, there is no specific direct way to participate in cyber security in India. It's more because most of the cyber security product companies, etc., are listed globally. There is like a cyber security company, very small cap listed in India, but it's not. I mean, it's not really. It's not a big company, so to speak. Therefore, yeah, there is no way to participate directly into the cyber security team. Most of technology based companies are in the US. Can PMS portfolios participate in that? I think PMS is kind of by regulations we are restricted to invest in India. Therefore, PMS as a vehicle cannot, at least to my knowledge. But I think there are a lot of AIFs or alternate investment funds, and which can invest globally as well. If you're interested in investing abroad. But of course, there are also mutual funds and things like that. So you can mutual funds also can give you exposure to global companies. Yeah, thank you, Suresh. So if there are no further questions, I think we can wrap up for today. Yeah, the recording is actually will be on YouTube. So the recordings for all our webinars will be on YouTube in ithoughtpms YouTube channel. Therefore, request you to look at our YouTube channel, and you can find the recordings as well. Yeah, thank you so much, everybody. Have a good weekend, and thank you for joining me today.